If I had to start investing today from scratch, knowing what I know about where this market is right now, how fast sentiment can flip, and how easily people confuse a pause with the end of the world, I would do everything differently. Most people think investing in a market like this is about buying the index, chasing the loudest chart, and hoping momentum keeps doing the heavy lifting. But that's not really what this is about anymore. We're in one of those moments where the headline averages can look strong, while the real opportunity is hiding underneath, moving unevenly, rotating quietly, and punishing anybody who gets lazy. If you position yourself correctly, you can use that. If you don't, you can spend the next few months buying the wrong things at the wrong time and wondering why your account feels stuck while the market keeps making new stories. Today is Sunday, April 19th in New York, so tell me in the comments what day and date you're watching from. And real quick, if you value this content, support the channel by subscribing and commenting John A.G. Best. That simple comment helps more than you think, because I think a lot of people are about to get surprised. Not because I believe the market is doomed, not because I suddenly turned into some permanent bear, but because this is exactly the kind of environment where everybody starts relaxing at the same time. And that's usually when the tape gets a little strange. The broad market just pushed to fresh highs as oil cooled off and traders cheered signs of de-escalation in the Middle East. That's bullish on the surface. It's also the perfect setup for a short-term shakeout if too many people start assuming the easy part is still ahead. And here's why I'm not in the camp that says everything is broken. Based on recently published numbers, first quarter earnings season has started well. FactSet said the blended earnings growth rate for the S&P 500 is running in the low double digits, with a very high share of companies beating both profit and revenue expectations. At the same time, the market is not cheap. That same report shows the forward price-to-earnings ratio sitting above both its 5-year and 10-year averages. In plain English, the market still needs good news. That means we can absolutely have a bullish, longer-term backdrop and still get a pullback that feels nasty in the short run. So if I was building a plan here, I would start with a simple rule. Own businesses and themes you actually understand, not just tickers that happened to go up last week. This is not the kind of tape where you can buy everything and expect the index to babysit your decisions. This is the kind of tape where selectivity matters, maybe a lot. Because some rallies are driven by real improvement, some are driven by positioning, and some are just fueled by short-term relief. Those are not the same thing, and they don't age the same way. Now let's talk about the big engine underneath this market, because whether people like it or not, artificial intelligence spending is still a major force. TSMC just reported a huge profit jump, lifted its revenue outlook, and said demand tied to artificial intelligence remains extremely robust. Microsoft had already told investors that capital spending was massive and that customer demand still exceeds supply. Alphabet, meanwhile, projected a very large jump in capital spending this year. So no, the build-out does not look dead. No, demand does not look like it fell off a cliff. And that matters, because when the infrastructure cycle stays alive, it doesn't just matter for chip names. It spills into cloud, software, power, networking, and productivity tools. But let me give you the skeptical version too, because this is important. Strong demand does not automatically mean every AI-linked stock is a buy right here, right now. That's where people get themselves into trouble. They hear that spending is strong, and suddenly every chart with the letters A and I in the pitch deck becomes untouchable. No. Some of these businesses deserve the enthusiasm, some have real earnings support, some are still too expensive for the rate environment we actually have, and some may be wonderful companies that still go nowhere for a while, because the valuation already baked in a perfect future. That can happen. It happens all the time. That's why I keep coming back to stock picking over blind index hugging. The next big winners may not be the exact same names that carried the last headline rally. You could still see select software names work. You could still see certain financials work. You could still see pockets of cyclicals wake up if rates cool and confidence stabilizes. You could still see some overlooked names outside the giant benchmark weights end up doing far better than the average investor expects. But that kind of market is never smooth. It's a market that rewards patience and punishes tourists. And patience matters here because the macro picture is mixed, not magical. The latest consumer price report showed inflation heating up again in March, with the annual headline rate stepping back higher and energy doing a lot of the damage. Core inflation also ticked higher. That does not scream all clear. It tells you the path back down is uneven. So if somebody tells you lower oil for a few days means easy rate cuts and a straight line up for stocks, I think that's too neat. Real markets usually don't move that cleanly. The Federal Reserve knows that too. The March policy decision kept the target range at roughly 3.5 to 3 3/4. Then just days ago, Governor Waller said cuts are still possible this year if the war shock fades quickly, but he also warned that prolonged disruption could keep inflation sticky. That's the kind of backdrop we're dealing with. Not panic, not certainty, conditional flexibility. So the idea that the market can wobble while the longer-term case stays alive actually makes perfect sense. Now here's where I think people are underestimating the opportunity. A lot of investors are still looking at this market as if the only thing that matters is whether the index itself keeps floating higher every single week. I don't think that's the right lens. If the index cools off for a bit, that does not kill the story in selected stocks. Sometimes it improves it. Sometimes you get better entries. Sometimes the best businesses finally get handed back to you after people chase the obvious names too aggressively. That's why I'm much more interested in what kind of pullback we get than whether we get one at all. Because a normal pullback is not a broken market. A consolidation is not a funeral. A few red weeks are not the end of the bull case. They can be the cost of admission. They can be the part where weak conviction gets flushed out and stronger money gets a cleaner setup. And weak conviction is a bigger problem than most people realize. If you own a stock and you don't know why you own it, that's dangerous. If you bought it because somebody on the internet said it was going to the moon by Friday, that's dangerous. If you're holding options on a company you wouldn't even want to own for a year, that's dangerous wearing fancy shoes. This environment demands clarity. You need to know which positions you'd be comfortable adding on weakness and which ones you're secretly hoping to escape. That's where portfolio cleanup comes in. If you don't have conviction, take the gift when the market gives it to you. Trim the stuff you don't believe in. Get rid of positions that only made sense inside a straight-up momentum chase. Keep your capital for the names, sectors, and themes that can survive a weird month and still look attractive 6 months from now. And yes, I do think the next several weeks could get weird, partly because markets often need to digest fast rebounds, partly because geopolitical relief can create a sell-the-news reaction, and partly because this rally still has that hated quality to it. You can feel that people don't fully trust it. You can feel that many managers were not ideally positioned and have been forced to play catch-up. Those kinds of rallies can run further than people expect, but they also don't move in a nice, polite line. That's another reason I'm not dismissing the bullish case. Even the bank earnings have been sending a message that the real economy is not falling apart in some dramatic way. JP Morgan reported strong first quarter results, card sales volumes were up, and Jamie Dimon said consumers were still earning and spending. Bank of America also reported a solid quarter. That doesn't mean the consumer is invincible. It does mean the base case is more resilient than the doom crowd keeps advertising. Now, I want to be careful here because resilience is not the same thing as euphoria. Housing still looks sluggish. Existing home sales fell in March, and the spring season has not exactly come out swinging. Mortgage rates have eased from where they were a year ago, but they're still sitting above 6%, which is enough to keep a lot of buyers and sellers frozen in place. That matters, because if rates drift lower over time, even modestly, you could unlock more movement, more confidence, and more spending tied to housing. But that is a gradual story, not some overnight miracle. Still, that gradual story could become a powerful one. The Federal Reserve's financial accounts show owner-occupied real estate remains one of the largest pieces of household wealth. So if financing conditions get even a little friendlier later on, the ripple effects can travel. More activity, more equity realization, more renovation, more furnishings, more transactions, better sentiment. You can see how certain financials, home-linked names, and consumer cyclicals could benefit from that without needing the whole economy to go into some cartoon boom. That's why I think there's a real 12-month story here, even if the next month annoys people. Maybe a lot of people. Maybe enough that they start saying the market peaked and the opportunity is gone. I don't buy that. I think the better interpretation is that the easy emotional rally may be maturing, while the more selective, more interesting phase may be just starting. That phase is harder. It requires more work. But it can also be much more rewarding if you know where to look. So where would I look? I would look at software with real customers and real cash flow, not just good branding. I would look at financials that benefit if activity improves and credit holds together. I would look at selected cyclicals that don't need a perfect economy to surprise on the upside. I would look at infrastructure-linked themes that ride the AI build-out without necessarily carrying the most crowded valuation in the entire market. And I would keep a close eye on whether breadth keeps widening, because that would tell you this is becoming more than a narrow headline parade. What I would not do is panic every time the market has a bad day. You don't plant a seed and start screaming at the soil 48 hours later. You don't throw away a good thesis because the chart took a breather. And you definitely don't let the crowd convince you that every pause is a prophecy. Markets breathe, markets rotate, markets fake people out. That's normal. What matters is whether the underlying conditions are getting worse or whether the tape is simply washing out weak hands. If you're successful, share your success story in the comments so others can stay motivated. And here's the last big thing. You do not need to own everything. You do not need to chase every rumor, every breakout. every must-buy-now stock of the week. Missing some moves is fine. Missing discipline is not. The investors who do best over long stretches are usually the ones who can sit with uncertainty, keep their plan, and press when the odds actually tilt in their favor. There's also a historical angle here that I think people misuse. They take a seasonal pattern, wave it around like a magic wand, and act like the market has already signed a contract to crash on schedule. That's not how this works. History can give you a rhythm. It cannot give you a guarantee. What history can tell you is that after fast moves, markets often pause, leadership shifts, and people who came late start mistaking exhaustion for collapse. That's useful. That keeps you humble. But it should make you prepare, not predict with fake certainty. And oil matters more than people realize in that conversation. The recent drop in crude after signs that the Strait of Hormuz was open again helped calm nerves and supported the rally to new highs. That's real. But if crude stays softer, it can help margins, sentiment, and inflation pressure a bit at the margin. If it snaps back, that changes the mood quickly. So when I say next week could surprise people, that's part of what I mean. The market is balancing earnings strength, sticky inflation, geopolitical relief, and valuation risk all at once. That's a recipe for movement, not boredom. So my view is pretty simple. Near term, the market can absolutely get choppy. The index can cool off. Some of the biggest names can stall. A few hot trades can punish late buyers. But underneath that, the foundation for selective upside still looks real. Earnings have started better than feared. AI spending still looks heavy. Consumers look more resilient than the panic crowd admits. And housing has optionality if rates drift lower over time. That does not sound like a market where you hide under the table. It sounds like a market where you get picky, stay patient, and use volatility instead of fearing it. Remember, the best setups often show up when good businesses get knocked down, weak hands get flushed, and patient investors are willing to wait while everyone else keeps demanding immediate confirmation. So no, I'm not calling for some giant everything crash. And no, I'm not telling you to buy anything with a heartbeat. I'm saying the headline market may be closer to a pause than people think, while selected opportunities may still be much earlier in their story than the crowd realizes. That's a very different message. And if you understand the difference, you won't confuse short-term weirdness with long-term failure. Everything here is for educational purposes only. I'm sharing how I'm reading the setup, not handing you a personal financial plan. So do your own work, know your own risk, and make sure any move actually fits your life before you hit the button.